Hey everyone, Mike Wise here with your weekly mortgage update. The big story this week is the job numbers. So the ADP report came out this morning and it showed only 22,000 jobs created in August, and June was revised down to show a loss of 13,000 jobs. This puts the unemployment rate up to 4.3% from 4.2%, the highest that we've seen in many years here. So also job openings are at their lowest level since 2020. Layoffs are climbing. Employers announced nearly 86,000 job cuts in August, the worst August since the Great Recession. So now, why does this matter for real estate and mortgages? Well, because a softer job market, it makes it certain that the Fed will cut rates in September at the 17th meeting. In fact, markets, they're already pricing in that cut, and the average 30-year mortgage rates have dropped. They're back near 6.5%. So what does this mean for buyers and sellers? Opportunity. So as the rates ease, affordability improves, and history shows us that demand comes back fast when this happens. So stick with me. Let's break it down and see what we have going on here. So let's go to the vibe board and give you an update here. So this week, tariffs, they were the talk of the town. This kind of drove market's kind of a little bit wild this week, and gold actually spiked and went up as a result of this. But the tariffs, they kind of drove the market and the stock market, and it's kind of, there was some nervousness out there as far as what's going to happen with the market. Well, it's still unseen as to kind of what's going on there and how that's going to be impacted. But the tariffs resolution to that will give us some more clarity going forward. So a couple of things that happened this week. JOLTS report. This is the job openings, labor turnover. This is showing, again, the job openings and the turnover. Well, it fell 2% month over month to 7.18 million. That's well below the expectations of the 7.4 million. And you can see the job openings, they are going down. The turnover is happening less and less. So you're seeing people stay at their jobs for a longer period of time. The employers, they're not switching employers. So you can see the job openings are going down. So this is a big deal. ADP came out this week. So this is the private sector jobs. The ADP report came out. It showed 54,000 jobs were created in the month of August, and they were expecting 70,000. So that was a big miss as well. So you can see the ADP and the BLS as well, but you can see the jobs are not, they're not coming back right now. So it is a challenging job market. And so we're starting to see, in fact, today, the jobs, the BLS jobs report came out. They were expecting 75,000 jobs, and that was a huge miss. In fact, we can go here and basically show that they only added 22,000 jobs for the month of August, and they revised June down to negative 13,000 jobs created. That is a big miss. This is what's going to drive the market, or the Fed kind of moving their Fed funds rate. So let's look at the September 17th meeting. There's basically 100% chance that we're going to get to 4%, because right now we're at 4.25%. We're going to get it down to 4%. So it's a pretty certain that they're going to drop it at least a quarter, and there's a chance that they may go a half a point. So, and then October, we're seeing that they're going down to 3.75. So that's another quarter if they only do a quarter in September. And then December, they're talking about another quarter. So we're dropping them fast here at the end of the year. We knew this was probably coming, but we just this is kind of the what we're seeing here as the jobs market looks less and less favorable at this point in time. You can see interest rates, they're driving down. We're right around that 6.5 level. So that's good sign for, bad news is good news for the mortgage market. And so you can see that the mortgage rates, they are improving. In fact, here's the yield We can show you right now we're at 4.07. That's down from, man, we were up at the 425 number. So we've dropped almost 20 basis points in the last couple of days. This is a big move in the bond market. Interest rates, this is a big number here, as well as the treasury prices going higher and higher. So you can see, I'll go to this graph here real quick. But as the prices go up, you can see here that the prices over the last couple of days, they've gone up. That means that the pricing, the rates get better with those rates. So again, it's a favorable pricing for mortgage rates. It's good news. This is Mike Wise with your weekly mortgage update. If you have any questions, please feel free to reach out to me. I will be available this weekend. Otherwise, I will see you next week. Have a good one.